Hello and welcome to the Gold Ghosts and Guns podcast for June 3rd, 2024. My name is Tom Luongo and we have a lot to talk about. It is episode 178. I'm going to go off of the Bitcoin, oh my God, the end of the world, geopolitics, and yada, yada, yada. We're going to get back to some kind of hardcore market analysis today. I've got with me friend and patron Ben Kelleran of Kontrarian, Korner. He's a CPA, he's an investor, and he's an expert in offshore oil services and whatnot. And we're going to get geeky talking about oil and oil demand and all of that and oil policy going forward. So Ben, good morning. Thank you for doing this, and welcome to the show.
Yeah, thanks for having me on. I think it's a very interesting sector and very interesting time to be looking at energy and different commodities.
Well, the thing is, it's funny, as we were, chatting before we press record, and we were kind of like working out how we're going to structure this one today. Because yes, folks, every once in a while, I actually do structure these podcasts. I know that Dexter White would be shocked to hear that. The point being is that when we were talking about this, I said, one of the things that we want to do here is ease people into understanding, why, from a policy standpoint, we know we live in an age of climate change and they don't want us to use oil and gas and blah, 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 blah. But we also know that there's no credible replacement for it. And part of the commentary that I've tried to put out over the years is that what you have is people who are shaping policy in order to retard certain aspects of the market and cock up the market and overcomplicate the market through environmental regulation and taxing and everything else in order to shift market dynamics in one geographic or one political jurisdiction to advantage over another. And the general theme being that we have an environment today where it's very clear that we have foreign actors working very hard to destroy the United States. But we have a weird moment in time where we also have the U.S. producing 13 million barrels a day, and no sign of slowing down, even if the Baker Hughes rig count is down 20% over where it was 2 years ago, which is a stat that everybody should keep their eye on every week. So I wanted to have Ben on the show today because I know that he's got ideas on what's going on today in offshore drilling and how that's going to affect, all of this. But from a policy standpoint, Ben, what do you think is, what do you see in that respect? How do we deal with the mixture, the bad mix of up, mid, and downstream? And you can even make sure that you define those terms for people so they understand what I'm talking about when I mean that.
Yeah, so I think the thing that's interesting to watch with the Permian is how you see rig counts and how production typically will follow that with a lag. So if you see declining rig counts over time, I wouldn't be surprised to see the Permian start to produce less in the next couple of years. Whether it's permanent decline, like people go back and forth, like it's really hard to kind of pinpoint, the Permian's going to start declining at this day, this time, and be real exact about it. But what I will say is I don't think we are going to see continued Permian growth for the next 3, 4, 5 years. But I mean, that all depends on kind of what happens on the regulatory front. But one of the things that's interesting is you see, like we were talking about before, like we haven't built a new refinery in the US for 4 decades, and we're blocking pipelines that are basically no-brainers, whether it's for natural gas or oil or whatever it is. So I think that's kind of one of the things that'll probably be restrictive moving forward as far as the energy space goes.
Yeah, that's the problem, is that, like I said, so, just for people who are not oil or even extraction experts, in general, you can think of things like upstream means the exploration and the actual production. So in this case, the crude oil well itself. Midstream is the pipelines, how we get the crude oil or the natural gas or whatever to the refinery. And then the refinery is what we consider downstream. And so in uranium, it's the yellow cake mine in Kazakhstan. The midstream is the trucking industry, the Russian trucking industry that brings it to the uranium processing facility to turn it into, uranium hexafluoride. And then we have, SWRs, and then we have nuclear fuel, and all the rest of it. So the same thing in gold or trucking refinery. Sometimes all that's in one place in a gold mine. So just so people understand that. So what you're saying really is that you don't think, you're not expecting the output out of the Permian Basin in Texas, which has been the big growth generator for the United States production overall, that's not going to increase from here. Now, now give me two good reasons as to why that you think that.
Yeah, I think the biggest reason, this is where you can go into government stats being garbage, whether it's the CPI and all these different things. But I think it's really hard to look at some of the trends there and say it's going to continue to grow from some of the stuff they've seen with different metrics on how they're like what they're counting as oil production. Like I know that's changed in the last year.
Okay. No, actually, I'm going to stop you there. Talk about that. I hadn't heard anything about that. That's actually really interesting because I know that they've changed. I know they changed the definition of Brent crude for a variety of reasons in order to manipulate price. So what do you mean by, well, have they changed the definition of a barrel of oil equivalent coming out of the Permian?
Yeah. Yeah. So I think they basically have been monkeying with the numbers. I think they kind of started doing it in 2023, but there are a couple of people worth following on that. It's Christine Guerrero is one. I'm actually having her on the podcast later this week. And the other one that I like to follow is, I think it's HFI Research. They have a good Substack where they write a bunch about some of that stuff. But basically, in the past, like what was considered oil production, like they've added some other categories in there to show higher production numbers than what would previously be showing.
Would this be like natural gas liquids or just gas itself? I mean, what are they doing to change those? And are they giving bigger credits to those things as opposed to they did in the past? I mean, how are they monkeying with the numbers? Can you talk about that in more detail?
I mean, a little bit, but that's probably a little bit above my pay grade. Basically, the natural gas liquids and some of the other things that in the past they'd separate out, they've kind of been including, but there's other people that are more qualified to speak on that specifically than I am. So
okay, so so in the TLDR on this is this something you need to be aware of, that 13.1 million barrels per day that the U.S. puts out every week, or whatever the current production numbers are, they're coming out of the EIA, may or may not be real.
Yeah, I would say I'm skeptical that it's the equivalent of what that 13.1 would be 2 or 3 years ago. So
got it.
That's it's not a sure thing, but it's just one of those things where I wouldn't be surprised to see more monkeying with statistics moving forward. So I guess one of the second reasons I think it's going to be an issue moving forward is, like you said, like if we're not continue to see added drilling rigs, and all this stuff kind of happens on lag, so it'll take some time.
Right.
But part of it's geology, part of it's the drilling rigs, part of it's like a lot of this is kind of baked into the cake already, where you see like faster declines in wells. Like I was writing about, I think a month ago, I wrote a piece where it shows like the faster decline rates and like what the Permian production has looked like, where over the last like several years, basically the whole Permian has been declining faster and faster from some of the wells they've been drilling.
Right.
And I think part of that's probably the amount of horizontal drilling they're doing, but part of it's also well quality and the quality of the resource. So I think it'll be interesting to see how that plays out over the next couple of years.
Yep. So what you're saying is that we're seeing, even though the rig count may be down 20%. And again, I've been surprised, to be honest with you, because I know, I check the rig count on a pretty regular basis just to see where we are. And I've been surprised that U.S. production has stayed up relative to the rig count coming down. So not only are there fewer rigs out there drilling, and part of that is because, it's a game they always play in oil drilling between the price of oil itself versus their access to credit to drill the well, right? And it's all about cost of production per barrel. So what's interesting is now we have fewer rigs versus say 2022 in operation, and they're drilling and finding they're drilling wells that aren't returning nearly the amount of oil that they had in the past, or some number, and which lends credence to, yes, we may have tapped all the easy stuff in the Permian, for example. Um,
Well,
and so
and the
that's
wells are, I was just going to say, and the wells are
yeah, yeah.
getting gassier over time too. So they are not producing the same kind of percent weighting of oil versus gas. So that's, I think, basically continued, like every year you see each of these Permian producers get gassier over time. I think that's another trend to keep an eye out for.
No, that's an important point, because we've been sitting here wondering how natural gas prices could get so low in recent times versus oil sitting there between $80 and $90 a barrel, or even WTI sitting between 75 and $85 a barrel. And I always tend to talk in Brent crude as opposed to WTI, but in this particular conversation, WTI is what people should be focusing on. So WTI is the West Texas Intermediate is the thing that we need to be dealing with. So thank you. So if we're dealing with that, and it stands to reason from a policy perspective that we can see what's going on with the Biden administration. Clearly, not just that they are blocking pipelines and so midstream stuff, and no new refineries. There are a couple of refineries that have been permitted in the last couple of years. They're going slowly through the permitting process. And I don't think that that's going to, there's a lot of NIMBY politics that once you get past a certain point, then the Soros bots show up and start screaming at the local county commission meetings that we have an oil refinery because, the birds and, groundwater and all this other rotten nonsense. And they forget that they need gasoline to get in their cars to go to the county commission meeting to bitch about, right? So it's like everything else. It's like people tweeting about technology from their iPhone. It makes no sense to me. But so we can kind of establish that we've probably hit a peak in U.S. production, but at the same time, they're trying to create the false reality that we haven't, because of course, up until the election this fall, this will probably last until the election, I think is the point I'm trying to get at. Tell me if you think I'm wrong about that.
No, I agree. I think there's also a pretty good chance, especially if oil spikes in the summer, that we see a strategic political reserve release at some point. But
Nice.
that's, I mean, to be determined. We'll see how much they can monkey with what's going on in the market as far as oil prices go. So
yeah, my thought here is that as long as they can get us over the line through the summer at around $85 a barrel, aside from the fact that it helps Europe with the overly strong euro and everything else, and we keep inflation numbers down, if they're also mucking with the production numbers coming out of the United States, that helps to give credence to the idea that oil is in oversupply, which, and you see a lot of competing headlines on this on a day-to-day basis, and really the news cycle every week around these numbers and OPEC and everything else. It's always like one day up, one day down, and the volatility in oil has washed out so many traders in the pits that it's easy to move the price now because there's fewer people actually trading oil than there used to be. And this is something this is a theme I've hit on in the past. So now the question is, we get past the election, you can easily see, the IEA numbers or the EIA numbers will start to drop off right after that, because politically it won't matter. U.S. production will go down. The price of oil can then rise because there's no political reason to keep it down, blah, 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 blah. And then we'll move into the next phase of the political cycle and the management of perspective economics that they always do. So, all right. With that said, I think we've beaten this horse as dead as we possibly could. Biden sucks. Yeah, no shit. Let's move offshore, right? Because I know this is your particular area of focus, and this is what you do over Kontrarian Corners. This is your thing. So now that we have an idea, because people should be asking themselves, okay, well, that's the case, then is oil a bull, right? And we're just sitting here in a lull here. And if so, and they're looking for a place to park their money, knowing that we're dealing with inflation, we're dealing with a return of inflation, we're dealing with all sorts of other things. And this is very much core, I think, to the whole, gold goes to the gun strategy, is to expect a commodity super cycle in some way, and that's going to be driven by oil prices. So let's move offshore and let's talk about the state of the offshore market, which is something that I have spent almost no time dealing with from a thinking about where to go stock picking in the last like 5 years. So from here, I'm going to shut up. I know you're all thankful for that. I'm going to shut up. I'm going to let Ben talk and tell you where he thinks the offshore industry is, the state of it, and what stocks are good. So Ben, take it away.
Yeah, so one of the things that's different about offshore is that it's basically super long cycle. So it's something where it takes 5 to 10 years to explore, find a resource, and get it to production. And it takes billions of dollars. So that's what you see like in Guyana with Exxon, for example, where they're producing now, but that's been in the works for, I think, over a decade. And that's turned into a real cash cow for the company. But like right now, as far as the service companies go, you can buy stocks in the sector basically at anywhere from 30 to 50% of replacement cost. And you see day rates have continued to go higher. And I think capital returns as far as buybacks and dividends are just getting started. Kind of depends on what you prefer there, if you're a buyback guy or dividends. But um, as far as the setup goes, basically operating these things have pretty high fixed costs but low variable costs. So the revenue increases, most of that flows straight to the bottom line. And what you're going to see, I think, is a lot of these things turn into cash cows over the next 3 to 5 years. So it's something where I think we're probably in the third or fourth inning of a long offshore bull cycle. And I think there's years to go for this thing to play out.
Okay, and yeah, no, that's really interesting because then the real question is, so what you're saying is, so what are we looking at in terms of what do you think they're? I'm not sure what the right metric is. We're going to start with cost per barrel. That they're pulling the stuff out of the ground offshore. I don't know if that's the right metric. If it isn't, let me know. And if their cost per barrel is in the 30s and we're trading in the 80s, it doesn't matter if oil goes down to 70. They're still making scads of money.
Yeah. I mean, it definitely depends on the field. Like you see certain places where Petrobras is pulling all out for just dirt cheap, and Guyana's, I think, somewhere in like the 20s or 30s per barrel.
Nice.
Um, and basically, it kind of depends on what the resource is and where it is and some of the different things there. But the the whole process to get it to production is obviously very, very expensive with all the exploration you need to do and all the stuff you need to logistics you need to take care of to get it to that point. But once you have it up and running, it's basically a cash cow, especially for
Right.
some of these major fields. So
Yeah. No, that's always been the thing is if you can get through again, as you said, these are not heavy. These are not heavy variable costs once you get into the production stage, and it's just then a matter of, well, they'll make $2 a share this quarter. Oil's down $10, they'll make $1.75, and it becomes a very easy an easy investment to predict what and analyze and figure out what's going to happen from there. So now let's talk about do you have picks in that space? Like, I mean, which
um,
oil majors do you think are the ones that are going to do the best? And again, you can go political, you know, you take whatever angle you want on this, but like talk about your like two or three top companies all from different perspectives. I'm going to throw everything at you here. So, which one do you think is, I don't know, which two or three companies for different reasons are going to be good picks in this space, and then maybe we'll get into well drillers and rig the rig drillers later, the rig companies later.
yeah, so I'm still holding Petrobras. That's been a fun year on that one.
Sure.
I am wondering if I am thinking about selling that one just because some of the political stuff going on there and some of the things that I wonder if that's played out a little bit. And there's also other things I want to buy. But as far as oil majors go, like you have a hard time finding another company that is a better fit for an offshore bull market than Petrobras with their assets.
Mm-hmm.
So there are some smaller companies that have exploration fields, and it's hard to kind of like those aren't cash flowing assets yet, but they have some resources and percentages, like basically a stake in different blocks that have the potential to be massive resources moving forward. So
Right. Right.
there's a
Right.
couple in Guyana, a couple in Africa, but as far as oil majors go, I think Petrobras is one to look at. I don't own Exxon, but obviously with their block in Guyana, that's I think
Right.
just getting started. So um, there's a couple other places, but I know Chevron's been getting more active in Namibia, and there's a couple discoveries down there that look like they're going to be massive. I think there's one last month where it's like something like 10 billion barrel reserve in offshore Namibia, and that's just in one block. So
Wow.
we'll kind of see how that plays out. But that's the thing about some of these offshore oil fields is they're massive, massive reserves, and it's if you hit one of the gushers, you can turn it into a real cash cow. So
Okay. So let's circle back to some of the stuff with Petrobras because I know that within the community, it's been a real lightning rod or controversy and whatnot. In our community because the big question that everybody's been on everybody's mind is what's going to happen. Petrobras being the Brazilian state oil company, for those of you who don't know what we're talking about, and the issue now has been with the change in government, with President Lula da Silva being more active in trying to change the company's economics because this is a company that has been a cash cow for frankly foreign investors for quite a long time, throwing off an insane 16 to 18, sometimes 20% dividend on an annualized basis. But at the expense of course, taking that money that they're, and I think cash cow in terms of Petrobras is the right term. And for those of you who don't know what we mean by that term, it's both a positive term and a negative term. You want to own a cash cow, but you don't want to be the employee of a cash cow because the company is not investing at all in itself to continue. They're just extracting as much money out of it as possible, and eventually they'll shut the whole thing down. And so this is, I think, the political fight over Petrobras is what Lula is trying to change is the influence of foreign investors who have who had outsized influence over the board and the direction of the company for too long, and they want to do a massive expansion of their assets and their production, exploration and production, and plow more money back into that and cut the dividend. And this has been a fight now that's been going on for over a year. So what do you think is, and I've been following it clearly, but what do you think, Ben, about the state of that situation? I have my idea, my thoughts on it, but I want to hear what you have to say about it first.
yeah, so I know last summer they went from I think it was a 60% payout ratio to 45%. And well, one of the ways I'd heard someone kind of put it is at that 60% payout ratio, they're basically self-liquidating, like you said, and it's something where it's just not sustainable. And you look at like what they have set up for exploration, like at the Amazon, which is basically geographically extended from Guyana. So there's a lot of potential with that field, and they have to explore and produce and
Mm-hmm.
do all those things there. And like I have nothing against reinvesting in the business, but like I bought shares at like $9.50. And I think it's one of those things where I'm not sure the risk reward looks the same at 15 or wherever at as it did like a year ago with all the political risk and people that kind of basically left it for dead. Like a year ago, I think you could have bought at $9 and the next dividend payout was like $1.10. And that was like
Sure.
within 3 months. And it's just like I don't know. I don't know what the dividend will look like moving forward. I think it's probably in the 40 cents a quarter range, but
Mm-hmm.
I think the massive special payouts is probably in the rearview mirror, but we'll have to wait and see. Based on their was it 50%? They paid out half the special dividend for 2023, so I'd guess investors will get that the other half in the back end of this year, but um it's not the same side of it was, which is why I'm kind of considering selling. So I wouldn't mind
Yeah.
hearing your thoughts on that as well.
Well, the bigger the question you should always ask yourself is, flowing to your bottom line, to your bottom line from the investor. I said it when, I've said it from every time we've discussed Petrobras over the last 8 to 9 months. I said, if you're getting 16% on any dividend payout on an annualized basis, you should not expect that to continue. That is there are very few companies in the world that can sustain a 16% dividend on a regular basis, unless it's that the price that you paid for it before the market sees the value in 16% return and then doubles the stock price and then effectively halves the yield, right? But if you bought it when it was a 16% yield and the stock price doubles, you're not only getting the 16% yield, but your underlying value has, your $10,000 position is now a $20,000 position, but you're still getting dividends based on the 16% payout rate from when you bought the stock. So from your perspective, for example, having bought Petrobras now the question as an investor, do you sell out and book the profit, or do you continue to part, even if they have the dividend where you were getting paid 30% or 28% at $9 a share, now you're getting only 8%, but it's still 16% to you. Is it worth it for you to keep 16% in the market, or can you take that chunk of cash and move it somewhere else and make 16% on it? That's the question that's the math that the individual investor has to do. I'm like, last I checked, treasuries are still only paying a 5.25. I don't know that I can see that many opportunities out there with, for example, an overpriced Dow or an overpriced FTSE 100 or an overpriced S&P 500 or NVIDIA, NVIDIA peaking into some ridiculous number. Like, where are you going to put your money in an environment like this where you can get, even 9%? And that's a good question to have given the situation. So from the way I look at it is that even if Petrobras has to pull the dividend back into the effective 8 to 9% range from where the stock is trading today, and they can do so, and even if they only hit half of their E&P plan, which from what I understand, they want to go from about 3.5 million barrels a day to upwards of 5.5 million barrels a day in the next 10 years, even if they only hit 4.5 million barrels a day, and we're looking at a general oil bull market, as you put it, as you laid out earlier. I still don't see that that's a bad investment. Are there better places to put your money? Sure. Do you have to be but it all depends on your risk part, your risk profile. So what I would say is, I'm an older gent. I'm 56. You're clearly not 56. I'm looking at you. There's no way you're my age. So your perception and your needs out of the investment are completely different from mine. I would be looking at the income side of the thing, right? And all the other risks, and then saying, for once, this hardcore libertarian, contrarian asshole is saying the government is actually doing the right thing. Because it looks, I'll be honest with you, I've looked at Petrobras from a particular perspective, and it just looks to me like, oh, this is Davos literally trying to destroy Brazilian oil production and the government's finances and everything else over the long term. I see Petrobras holding a 16% dividend carrot out there as really the stick to destroy the country. That's what I see. Because as you pointed out earlier, a 60% of profit payout rate is a self-liquidation rate. If you drop that to 45 or you drop that to 35 or whatever, and you acknowledge the fact that you've overpaid investors to this date, well, then you get over yourself. And, and then the question is, do you want a long-term investment that's going to pay you over 10 or 15 or 20 years? Or are you looking for the next 2 to 3 year time horizon is the bigger, and that's the big question, I think.
Yeah, I think it's interesting to think about as far as income goes, because you're not going to find many opportunities out there for a double-digit yield in really any sector. But if you're looking for a mix of buybacks, dividends, capital appreciation, all the stuff that a lot of investors do look for, I think that's where you can kind of get into some of the offshore oil services stocks, where I think the point we're at in the cycle now, I think there's more upside there, probably more risk as far as the setup and size of the company and all these different things. But I think a lot of these stocks are basically anywhere from 2 to 3 to 5 times in this cycle, whether that's a 5-year kind of longer term outlook. Kind of depends on what you're looking for, but um, that's I think where I'd be looking as far as kind of the asymmetric setups. So I don't know if you want to jump into
Oh no, yeah,
some of
I
those,
absolutely want
but
to jump into this because what we're talking about here is we're talking about getting out of integrated oil majors that do everything up, mid, and downstream into specific aspects of the sector of the entire sector, which could do very, very well. And then as an investor, you can pick and choose which of you think is the better way to go based on your risk profile, based on your needs, yada yada yada. So no, I'm absolutely. That's half the reason why we're doing this podcast this morning is we're going to pick your brain on that one. So go ahead. Like I mean, so talk to me. Like what I mean in the offshore oil business, we're talking about like Transocean and Seadrill, though I think they got bought. Or I know there's only a few major offshore, stocks out there, so that are worth anybody's time. So talk me through those.
yeah, so basically after the peak, last cycle peak in 2014, 2015,
Mm-hmm.
most of the companies in the sector ended up going bankrupt, reorganizing, doing all that. Transocean is one that basically made it through, but now has a very leveraged balance sheet because of it.
Yes.
So there's a lot of torque there on the upside, but maybe it'll make sense to kind of break down some of the different subsectors. Just talk about the offshore service vessels, which are the boats that you need to maintain and repair and basically get crews out to the rigs. And then you have jackups, which are basically shallow water assets. So anything up to, I think, 500 feet of water, those can operate in. And so you see a lot of those in the Middle East. And then deep water rigs, right? That's where you have anything where it's a couple miles of water and obviously drilling under the surface from there. So basically, those are kind of the three that I focus on. There's some stocks in there that I think are very attractive today, but um, kind of
Well,
across the whole area, you've got all these stocks where if you kind of pencil out like, okay, what would it take to build their fleet from scratch and kind of compare it to the market cap and their debt and everything, like I think they're basically trading anywhere from 30 to 50% replacement cost, depending on which stock you're looking at. So I find that
that's
really
really
attractive.
That is really attractive. It's where in effect what you're saying is that in general that market has been beaten down, and I think a lot of the reason that market continues to be beaten down is because of all the things I was talking about earlier about the policy stuff. That there's this general push to shy investors away from this space, given that climate change and carbon credits and you owe the government a life debt and for just being born and all the rest of it, and now you're not allowed to use oil, and so that's part of the market psychology, and I think it's a very important part of the market psychology, and it's ultimately in the end being gaslit by morons, but it's also being gaslit by vultures who don't want you to put your money in that space because they're putting their money in that space and they want to buy these stocks at perpetually undervalued prices until they're ready to allow the stock prices to rise. And then they're going to pimp you on CNBC and Bloomberg and everywhere else. Once they've started to reach full value, that's when they're going to tell you, oh, now it's time to buy Transocean or Seadrill or Tidewater or any of these other companies. Tell me I'm
Yeah, no,
wrong.
they'll mark it up 200% from here and then tell you on CNBC it's time to buy. But
Right.
that's kind of how that goes. But I think like you said, you kind of look at the whole climate grift and all these different things that you see going on with basically self-hating policies around energy and can't own any of these stocks and all these different things. I think that's what makes them very interesting for someone that has a contrarian streak with their investments. So
Yeah, no, I think that's the thing you want to talk. So let's drill into that a little bit. I when I the okay, so it's interesting you say 2014, 2015 because I saw the crash in that sector back then when I was working for Newsmax at the time, and that's when I was looking at companies like Transocean, and I could see what their plan was. And of course, the stock kept dropping and getting crushed. I eventually had to get out of the position, but um, but I could see it. I was way too early on the call of when to get back into that company. But at the same time, you have the people who actually build the jackup rigs and build the offshore rigs and everything else. And that would be somebody like Keppel Corp over in Singapore. And I don't know how many others are. So again, it's like if you like the offshore oil sector, there's still multiple places to invest. You go into the drillers themselves, or do you go into the people who are building the drills? And so then it becomes, who's building the rigs, and are they making money, and do they have a decent balance sheet? And so what do you think about the difference between the builders versus the it's like it's the same thing in shipping. Do you buy the company that moves the oil around, or do you buy the company that builds the ships themselves, right?
Yeah, so from looking back at the last cycle, like a lot of the shipyards basically got bankrupted in um, basically the trough there. I think, at least personally, I find the offshore oil service companies to be the place to be for now. I don't think
Okay.
we're going to see new builds for offshore oil services for, I don't know, at least 3 to 5 years. Um, but I think there is going to be a point where the shipyards start inflecting. You start to see um, those make sense as investments where they're getting a lot of new orders, and it starts to turn very attractive. Where I think there's a time for it, but I don't know that it's here yet, is what I'd say.
Fair enough. And why do you think that? Is it because credit's too high, or there's a glut of offshore drill rigs and jackup rigs out there? I mean, like, what's the general thesis?
Well, we're definitely not in a glut right now, but kind of what happened last time, I think like they basically increased supply of like deep water rigs and jackups and all these different subsectors by like 30 or 40% in a couple
Mm-hmm.
of years. So that basically crashed the price that they could contract for. At the same time, you had oil going from wherever it was down to like $30 a barrel or something. So
Right.
that's
Right. Right.
obviously an issue for that sector. But um, as far as the reason the shipyards, I don't, I've looked into them a little bit, but I don't find them all that interesting yet. Is basically to get to new builds for any of these sectors, you need day rates to go high enough for like the deep water, the jackups to basically incentivize companies. Hey, we want to build new production instead of just
Sure.
doing buybacks or dividends. And so for like offshore service vessels, like right now, the leading day rates are basically like 30,000 a day. And
Mm-hmm.
from some of the stuff I've seen, we'd have to go probably to 45 to 50,000, depending on how much it costs. And
Right.
um, I think it's like 70 to 80 million for like a new build OSV. But I mean, it really depends on the type of ship. Those are a
Sure.
little more varied than jackups or deep water.
Okay.
For jackups, you probably are looking at a new build cost of 300 million, and like you probably need at least 250,000 day rates for that to happen, and probably higher.
And what are we
Um,
looking at today?
right
We're
now, leading edge day rates on jackups are basically 200,000, but one of the things, um, those are kind of it's interesting to watch with jackups because there's been a whole narrative around the Middle East, which is I think 40% of the jackup market. That Saudi Aramco is basically cutting back on investment and all these different things. So day rates for jackups are going to be weak in the Middle East, and there are a couple of companies that are more exposed there than others. But I think like the long term supply and demand dynamics are basically the same for jackups as deep water and OSVs, where there's like an old and aging fleet. A lot of it's cold stacked. A lot of it's never going to come back online again.
hmm.
And you're basically going to need, um, you're basically going to need to see day rates go a lot higher for for the service companies to even consider building new ones.
Right.
And so like Saudi Aramco obviously has a little more influence on what happens with jackups than like what's going on in deep water, but I still think longer term we're heading a lot higher on day rates, and all these things turn into major cash cows as far as
Mhm.
the amount of money they're producing. But I think it's still a cycle that has, I would say, 3 to 5 years to start seeing new builds, and then it obviously takes time to build them, see those ships hit
Mm.
the water. So you kind of have the dual runway there as far as the investment time horizon.
Yeah, well, what I would think as I was listening to you talk, the thing of course I'm thinking is, had we are we if we were still talking about global interest rates in the 1 to 2% range as opposed to the 5 to 6% range, that's also a different issue. The cost of I mean, in terms of, it's building these things. Remember, this is like straight up Austrian business cycle theory. The longer the time horizon on the investment. So in the case of an offshore oil rig, this is a big commitment. The higher the time frame, so the more interest rate sensitive that particular thing is. So ships, offshore oil rigs, refineries, things like that, they don't get built at 5 and 6% as quickly unless there's an acute demand for them. And what you're telling me and what I'm hearing is that there's no acute demand for them. There's still plenty of older ships out there to keep the industry plugging along until the risk to reward ratio in a high interest rate environment, with the threat of global war, with the threat of interest rates going even higher, unless of course we see oil prices moving, above $100 a barrel or $120 back into that range to justify the higher day rates. Am I off on this, or talk to me?
Yeah, I guess on the supply picture, I think we kind of are in a pretty tight market kind of across the sector. I don't think there's all that much spare capacity.
Mm-hmm.
What I will say with the deep water side is you have several cold stacked rigs that probably will come back online at some point. And I would guess we start seeing that in the back end of this year. But after that, it's basically like what you have is like that's the fleet. There's no very few new builds or capacity that can come online
Sure,
without seeing that. So like there is some spare capacity in each of these kind of subsectors, but
sure,
I think that's going to get brought online pretty quick, especially if we kind of get the oil bull market that I'm kind of expecting. I think we all kind of see coming, whether it happens this year, next year, kind
or
of
next.
take some more time is up for debate. But I think at some point in the next 2 years, you're going to see people realize like, oh shit, we don't have enough of these things. Like, and then you're going to see day rates really go. And from there, it's going to be a long time once we start getting new builds for these things to even um, bring on new supply. So, like, just going back to, like you said, the cost to get these things up and running, like for deep water, like you're basically looking at like $1 billion for a new build or 1.2 even.
Mm-hmm.
And if you kind of look at like this being an inflationary environment and all these different things that I think makes sense to keep an eye on, like I wouldn't be surprised if the actual new build costs, like when they start doing it 4 or 5 years out, like I wouldn't be surprised to see like 1.5 and
1.6. Yeah.
some of these bigger numbers where it's just like what day rates do you need to justify that? Like right now we're at I think just kind of crossing 500,000, and on some of the calculations I've seen, like you'd probably need 700 to 750 to
Right.
start seeing new builds right now. But you kind of go out like, and this is where you can kind of get some people being hyperbolic on social media, but I've seen people talking about like $1 million day rates this cycle, and that's obviously not a near term thing, but like 5, 6, 7 years out, like I mean, depending on what oil
Yeah.
does, I think that's definitely a possibility. So
And yeah, no, I think I see the same problem in shipping, right? Again, and this gets back to policy and how these things are we're seeing intentional roadblocks put up in front of various aspects of the entire energy sector in order to create choke points that can be controlled within the supply. We see it in shipping. Like there's no appetite for new builds in shipping either. Certainly, again, at 6%, when there's plenty of, but the world needs more Supermax, Aframax, and VLCC oil tankers running around the world, because we're not allowed to contract with Russian oil companies, and we've seen all that stuff play out where, the EU and the US says we're not taking any Russian oil, for example, and that changes the entire layout of a very well oiled, for lack of a better term, and all puns intended, machine of moving oil around the world and what the cost structure looks like. And then the minute you say, well, we can't run from Ostluga to Rotterdam and back again, we have to go to Bermuda. We have to go from Ostluga on the Barents Sea to Bermuda, mix it with Bermudan oil, with Nigerian oil or American oil, and then send it back to Rotterdam to say it's not Russian oil anymore, even though it's 75% Russian oil. Like, and that just it takes a 2 week copy and cake run, turns into a 2 month nightmare. Or they got to do offshore ship to ship transfers and all this other stuff. And all of a sudden, the world stood there and went, we need 30% more oil tankers in the world than that exist. And yet, in the high credit and a high interest rate environment, there's still no appetite to do new builds. There's just, hey, we're just going to, and we'll just live with the higher day rates while these companies, all these shipping companies, repair their balance sheets from the last time they fucked with the market like this 10 years ago when they decided to take oil from 125 a barrel to $30 a barrel in order to try and get rid of Vladimir Putin. Like, this is nothing new, man. Like, I'm now around this thing talking about it from both the political and like diving into the sector. This is why I'm like, I mean, I'm glad you do what you do. Like, but from my perspective, I'm like, I just all I got to do is watch what Davos is trying to pull off, and I can see it like downstream, all puns intended again, when we start getting into the numbers of what's happening in the sectors themselves. And so it just becomes really interesting. So TLDR on this, the midstream guys, just like in shipping, moving the end product around, the midstream guys, the guys building, the guys who have the rigs to pull the oil out of the ground, are the ones that are going to make money in this part of the cycle. Is that what I'm hearing from you?
Yeah, so basically, I think the companies that contract, whether it's the jackups, OSVs, and deep water rigs, I think they're basically going to turn into money printing machines over the next, call it 5 to 10 years. And
Right.
like you look at like a Tidewater, which one of the things about OSVs is that they have typically shorter contract lengths. So I think they're like an average of 9 months. And so their
Okay.
contract book has rolled over faster. And you see it in their quarterly results where it's basically revenue continues to accelerate to upside, and like it basically is turned into people realize like how fast this business is changing. And so the stock is up like pretty massively since the bottom a couple of years ago. And I was a
Right.
little bit late, but still holding that one because I think it's got a long way to go before we start seeing new builds and before we get to a point where it's like, okay, it's time in the cycle to move on. But um, with the longer contract rates or longer contract durations of jackups, which I think is about a year and a half, and then deep water is a little bit longer than that, you basically have a little bit longer lead time for that to start showing up as much. But you're still seeing like higher average day rates, and a lot of the new contracts being signed are basically pushing highs for this cycle and all the things that you'd like to see. And that's kind of the setup where I think it could go on for, I would say, at least 2 to 3 years. And that's something you can obviously reevaluate along the way. But
Sure.
like in the jackup space, like there are a couple companies that I think are interesting, but the one that I own there is Borr Drilling, and you just see their revenue basically marching straight up and to the right over the last
Right.
couple of years. And like they basically termed out their debt, and I think they have maturities in 2028 and 2030 now, but they started paying a dividend. They authorized a buyback of $100 million, which they haven't
Right.
started buying back yet. And they actually have two jackups set to be delivered by the end of the year, I think. And they basically have decided, yeah, we're basically going to dividend out. So they just doubled the quarterly dividend. So now the yield on that is like 5.8%.
Nice.
And it's like it's like I think it's being conservative, but I wouldn't be surprised to see another dividend hike by the end of next year.
Yeah.
And I think that's one of those things where like right now their setup looks really good, and I wouldn't be surprised to see like the current capital returns program look like a drop in the bucket compared to where 2026 is, because they're basically their entire contract book is wide open except for I think like 9 or 10% from
Mhm.
2026 and beyond. So
Okay.
if
You
you're
don't want to give the whole story away, dude. That's what you do for a living. Like,
no, I get
I know my point being here is that when I'm listening to you talk about this, and I'm just like, yeah, no, that's the kind of analysis you want to do when you're looking at. I mean, what Ben is doing here is like walking you through how to look at how a particular company can, where they are now relative to where they're going to go, and what that could look like. But let's go back a second just to kind of clear things up for I don't know, the layman or the newbie to the sector. Is it fair to say that when you've got OSVs 9 months or offshore, that's OSV stands for offshore vessel. So they're on a 9 month contract. You got a jackup rig on like an 18 month contract, and you've got an offshore rig on say a 3 to 5 year contract. That's the equivalent of going short, medium, and long term in terms of if these were bonds, like like OSVs are the equivalent of buying 9 month treasuries, and you understand what I mean? Because at the end of the day, this is one of the things that I've learned from you know from other CPAs. They say, and then I'll invoke Dexter White here. Says like, everything just becomes a bond equation at the end of the day. It's a bond equation. How much are you expecting to get off of this thing in bond in terms of the appreciation of the bond and the coupon that it's paying? And if you can, get those numbers in the right place, then it's a good buy. And if it's not, if it's not, it's not. So for the people listening, the more risk, the more volatility you want to take, the shorter duration you go. And that's where you could wind up with a tremendous amount of upside, because the market's going to be continually reevaluating the company on a 6 to 9 month basis as rigs come off of contract and they roll over into the new day rates, and you can track day rates on a regular basis. Or if you need predictability, you go out into the offshore drilling platform companies, or the ones that do more offshore drilling platforms than OSVs, and now you have in terms of their portfolio. And now you have a much more predictable thing that you need for income generation over the longer term. This is, again, comes right down to, do you want to effectively, and all of these could be growth companies, but they're going to grow at different rates and in different ways with different levels of volatility and different levels of risk. Is that a good way of like summarizing what you just said in terms of how the market is structured?
yeah, I think at least right now the way, and this is kind of more just a gut feel thing. I
Mm-hmm.
think the OSV cycle is probably a little bit further along than jackups or deep water.
Okay.
And I would guess Tidewater will probably be the first holding that I'll plan to sell, or at
Got
least
it.
start to trim back. But I still think that's at least a year out, probably more. But um, as far as the longer term side of things for deep water, like if you kind of force me to say, all right, close your eyes and hold one stock till 2030. It's Transocean without a doubt, because I think they have the best management and I think they have the best fleet as far as their setup there, and it's pure play deep water. Whereas a lot of the companies in the sector have a mix of jackups and deep water, and so that's
Mm-hmm.
like Noble and Valaris are the two that I think are worth mentioning because they're some of the biggest. But um, like you said, if your time frame is like if you're trying to hold like a very cyclical industry for a longer time period, then you're definitely going to be more attracted to like the deep water or
Sure.
even jackups. So it kind of really depends on what you're looking for. But I basically
Yeah.
have taken a basket approach where it's like I think they're all so attractive that it makes sense to have a bit of exposure kind of sprinkled in across the sector.
That's always a smart way of playing any of this stuff, because you know there's no reason not to. Again, it comes down to these are not um they're not investing. Is we tended to want to do investing sometimes because we're all, we can be a little, we all be a little geeky or a little, a little aspy about this and go, okay, I'm going to solve all the math, and here's the differential equations, and here's the solver where everything is. This is the most optimal path. And then 3 months later, you got to redo the whole thing because the world happened. because reality happened. And like, so do you really want to be constantly actively dealing with that? Or do you want to, just say, okay, I'm going to do this. This is my strategy. And, sometimes it's best to just have a plan that is more flexible. And so you take a slightly lower payout rate, but you still get your dopamine hit when the thing like has you have a bang up quarter in one of your stocks and the thing pops on you. You're like, hey, and then you go out and you have dinner that night and you're making money. And it doesn't matter that you could have made an extra 10 grand had you put all your money in that stock versus only having 25 or 30% in the stock. Like, this is the thing we all have to kind of get over, that the purpose of investing is to hedge future risks so that you can go and live your life with less stress. So not everything has to be an optimization package where you're like finding the firing solution that's optimal. Just do a thing and be happy. And it's a lesson that I learned from listening to Jim Sinclair for years. And I keep bringing it up in other idioms, which is that, try and catch somewhere within the bottom 20%, near the bottom, and sell somewhere within the top 20% of the top, catch the 60% in the middle, leave the rest on the table for the God agreed, and walk away and be happy with yourself. Because in markets like this, and especially politicized markets like this, the biggest advice that I can give to anybody is that if you get any kind of positive return on a trade when they're running the Muppet Show on you on a daily basis to try and rob you of your money and your reason, well, then Christ on a crutch, don't beat yourself up for winning. Take the win and move on. And I think this is the kind of thing. But I know that when you start getting into like the CPA mindset, they can be like, oh, well, this is more, and then you get lost in the math. Don't get lost in the math. Always take a step back and take a holistic approach and go, that's good enough. And maybe there's a better play than I have today, but take your time and find it. Let it come to you, because you have experience and knowledge in the sector now. And now you can very quickly figure out what's going to happen. So that's what the purpose of a podcast like this is. Yeah.
I think for a sector like this is more important to be like directionally correct and not like, oh, once the exit multiple hits this, and like trying to get like diving into spreadsheets, because it's just like I have no idea what the exact numbers look like in 2030, but I have a pretty good idea which direction things are headed from here, and that's, I think, the most important part to be aware of. So
that is where we're going to end. That is exactly correct. You want to be directionally correct in the sectors that are reasonably convinced that you're going to do well in, and then you pick some stuff in that sector and you walk away, and then you just keep checking in with the general thesis that the sector is doing well, and if so, you're making money and you're doing well, and you can go down and live your life and play with your kids and pet your dog and, watch a movie and do the thing. And that's what we're supposed to be doing with this. So Ben, that was great. I really appreciate you taking the time to do this. And I know we've tried to get this one off the ground a couple of times and failed, mostly because I'm completely and utterly disorganized on even the best of days. So I really appreciate you coming in, giving us a look at what's going on in the offshore oil sector, because it's really important, and I think it is a really good opportunity. It's part of the reason why I wanted to have you on. So, and shamelessly, I get updated as to what's happening in the market that I don't have time on a daily basis to look at. So, it's all good. Appreciate it.
Yeah, thanks for having me on. If any of your listeners are interested in checking out some of my stuff, you can find me on Substack or on YouTube. I basically just started a podcast. I've had some interesting experts on, had Matt Warder on the coal sector recently. So that's another area of interest. But if you want to find some of my other work, you can find it on Substack or find the shit posting version of me on Twitter. So that's
and the name's there. Let's do this properly. And the name of your Substack is?
The name of the Substack is Kontrarian Korner. So that's with 2 Ks.
Excellent. Appreciate it. I'll have all the links to the show notes in the show notes to this episode. Thank you, Ben. And we'll do this again soon. Appreciate it.
Yeah. Thanks for having me on.
Well, I'm about to wrap it up for episode 178 of the Gold, Goats, and Guns podcast. I want to thank Ben Kelleran for coming on and sharing with us some great insights into all aspects of the oil markets, especially the offshore industry. I think it's just a good thing for us to kind of change up the pace every once in a while and just do something focused on a particular sector that's relevant to everything that we talk about in other areas of other episodes of the podcast. So with that said, you can check Ben out at his Substack over Kontrarian Korner. That's spelled with 2 Ks. And same thing for Twitter as well. It's a Kontrarian Korner spelled with 2 Ks. So with that said, I'm out. As always, you can follow my work at my blog over at tomluongo.me or goldgoatsandguns.com. You can follow me on Twitter at TFL1728. And you can sign up for the Patreon at patreon.com/goldgoatsandguns, where you can sign up for the newsletter and or the twice weekly market reports and private podcasts, so the morning ruminations and whatnot. And that tries to tie all of this up into a coherent portfolio strategy to help make you sense of this crazy freaking world. So with that, I'm done. You guys be well. You take care. We'll talk soon. Keep your stick on the ice.